A mathematician known as Stochastic Ito. He prominently features in publications. His equation Ito lemma is actually one of the most difficult mathematical parts, but his immense contribution was required for option pricing and for a lot of innovation which happened in finance. When we talk about, we need to understand Brownian moments, and understand Markov process is a type of stochastic process, and Brownian moment is a part of Markov process. So we'll just look at the overview. We'll just talk about it, not go deep into mathematics. The stochastic process. It's any variable whose price change over a period of time changes in an uncertain manner. Basically, it could be either continuous or discrete. Whenever you're talking about price movements of stocks in the markets, they are actually taken in continuous manner. Although stock markets, open and close, and this only for a certain period of time stock moves, it's more akin to a variable which is continuous in nature. Markov process is a type of stochastic process where the current value of a variable is important in predicting the future, where only the current value, the past information has no bearing on what's going to be happening in the future. Now it goes very strongly with the weak form of efficient markets. And the fundamental, when you're talking about, you will more believe on the fundamental aspects of valuation. So fundamental valuation is basically the intrinsic valuation which I talked about in the valuation model, and that is what would be discussed on the middle road, or what we'll be following. Intrinsic value is one of the best parameters of predicting the price of an asset or a security. So when we talk about Brownian moment, which is basically the Wiener process named after the scientist Wiener, it's a continuous time stochastic process. Particular Markov is it's totally independent, so it works with the increments. And these increments are very small, and process over the finite time is normally distributed. That's variance increases linearly over time. So we'll discuss this is a very important concept. When we talk about Brownian moments, so this is like a binomial distribution which I've talked about. Let's say a stock is going to go up and down with a constant increment of delta H spread out over a period of time. So the going up probability is P, the probability of going down is 1 minus P. Total probability, when we'll be talking about probability, is 1. The probability of anything event happening of 1 is absolutely 100% sure. So probability goes from 0 to 1. A valuation which goes valuing options. Now to give you a fair bit idea, when we talk about random walks, this is the theory which is a random walk theory. The lemma is important to differentiate our functions of Ito process. Is a critical role in the derivation of actual monotone results. So random walks, when you talk about random walks, we talk about Brownian motion. Actually, Einstein or paper on Brownian motion, it's freely available on the net. Paul Samuelson, he's the first American to Nobel Prize in economic sciences. He said economics has never been a science, and it's even less now than a few years ago. This is a very important comment coming from himself, Paul Samuelson. His book in economics is, I think, a benchmark book in around the world economics. Markowitz is father of modern portfolio theory. In 1952, he came out with the paper Portfolio Selection. It was a groundbreaking paper, and his thesis was, when you want to select a security, it becomes in the selection of securities more on selection of portfolios rather than individual securities. It's a risk return concept we'll be discussing in depth as we go forward. Portfolio gives the highest expected return for any given measure of time, is the most efficient portfolio. So when we were talking about his contribution to efficient portfolio, and we'll also see how Eugene Fama also defined it, it's the portfolio that will give you the highest expected return when you're looking for a given measure of risk. And whenever we are talking, like we said, when you're talking about expected return of a portfolio of assets, and we want to see an expected risk measure, the portfolio risk. How do you see the portfolio risk? You see the variance of the rate of return. You're measuring the risk, you see the variance of the securities within that portfolio. Efficient concept and assumptions is basically, whenever you're looking at return and you're looking at the risk measure, all investors will look at risk measures depending on different time horizons. So in his own words, there is no perfect portfolio simply because your risk measures are different. Best portfolio will be the best return or expected return of which the portfolio gives, looking at your risk, your investment risk. So these risks are divided into different time intervals. So basically the theory assumes that you maximize one period of expected utility, and they have a diminishing marginal utility of wealth. That's a very important concept. In economics, I kept on talking about how the various measures are diminishing over a period of time. You're looking at, it's very important, this is the efficient frontier. You're taking standard deviation on the x-axis and expected return, because your risk is defining what sort of return you're getting. In a way, you could say is that expected return is a measure of the standard deviation of return of your portfolio. If there are all these portfolios, what it says is, let's say you are comparing portfolio A to portfolio E. Portfolio A and E has the same standard deviation, but portfolio A is by far more efficient because it gives you a higher measure of expected return. Similarly, if you are comparing portfolio A and portfolio B. B has got a lower standard deviation as compared to A. That means got a lower risk as compared to A. Return expected from B will be lower than the return expected from A. A and E are on the same risk profile, but A is much better than E, is more efficient. Similarly, with B would be more efficient than C, which is here. Looking at it, because C will be giving you a higher return as compared to B because it's got a higher risk. You have a fair bit of understanding in the risk reward matrix. The more risk you take, more expected return, which is what an investor would require. So when we're looking at efficient frontier, we look at utility curves, very important. The utility for two papers, so about utility of the utility is a function of expected wealth, whatever expected return we're getting over the wealth, deviation of that wealth. So when you're looking at this U1, U2, U3, these are risk averse investors, and U1 star, U2 star, U3 star, less risk averse. That means they could take more risk. That's why utility different. When we're talking about utility curve in general, when you're comparing, what it means is like a millionaire's value of $1,000 is a utility is much lower than somebody who's earning $1,000 per month. So just to give you a perspective, you have sets of investors. When you have risk averse and the risk are more aggressive, so their utility function different from each other. When you're making a efficient frontier, for every individual, what is the best optimal return depending on the risk profile or the utility function of that investor. At one point of time, this is a diminishing return because you could keep taking an extra risk for a higher expected return, but after a point in time you would not like to take more extra risks because the incremental return does not make sense. When you're plotting an utility curve here, this is from Keith and Brown. Now you'll be taking the tangential view. For U2, this is the point of tangent. This point of time is the optimum portfolio. So this point of time will be the best portfolio based on the risk profile, the investor who is in the utility curve U2. The optimum portfolio is very different from what is on U2 star. So U1 will be on the tangential line, the line of efficient frontier with U1. The point of the tangential is the optimum portfolio for investors on U1.